Welcome to Stocks in Translation, broadcasting from the New York Stock Exchange. I'm Jared Blickery, your host, and with me is Yahoo Finance's Madison Mills. The people's voice is on assignment. And before we get started, kindly like, subscribe, and comment on Stocks in Translation on Spotify, Apple Music, Amazon, or YouTube. Today, we are welcoming back Michael Ranking, CFA. He is a senior market strategist at none other than the New York Stock Exchange. Hello again. Our phrase of the day here is terming out. It's one of those wonky bond market terms, but fortunately it's easy to understand, and it's part of the $37 trillion question in the US right now. And this episode is brought to you by the number 77. That is the relative strength index score for consumer staples, the stuff you need, divided by consumer discretionary, the stuff you want. Exactly why is the market favoring the stuff we can't just live without? So Michael, before we really dig in, what are you seeing in the markets right now? Interesting year so far. And I got to say for the audience, we're taping this right ahead of NVIDIA earnings, so we don't have the benefit of that knowledge, but there's a lot else going on.
Yes, yeah, well, first and foremost, thanks for having me back on. Yeah, look, I mean, it's been an interesting, kind of start to the year where we got off to a pretty solid start. And then like we do see in, kind of in February's, in many years, and especially after elections, right, we've seen a choppy, kind of February, up to date, and we've seen, kind of over the last week, we've seen a pretty, significant momentum unwind, where there's been some of the really kind of crowded positionings and popular, kind of risk-on assets have really started to unwind, and markets are, kind of dealing with multiple different narratives, around, potential growth scare, kind of Washington policy fog, all right, and it's just kind of weighing on, kind of overall sentiment.
Yeah, I remember last time you were here, you were talking about the potential for some headwinds in Q1, and that's exactly what we saw in February, right on cue for followers of seasonality. But right now, we want to get to our phrase of the day. It comes from the bond market. It's called terming out. And that is when the government or a company, could be a corporation, replaces short-term debt with longer-term debt. And that is so they can lock in lower interest rates and reduce the risk of refinancing. That's having to go to the debt market every few months or 6 months. And so that's kind of a strategy that we've been talking about that the Treasury might need to implement because we have a lot of debt and there's a lot more short-term debt than there used to be. How are you thinking about this, terming out?
Yeah, so I mean, in terms of terming out, right, that's actually been a really important dynamic, not only from a Treasury perspective, but from if you think about households, right, and companies over the last couple of years, and really been one of the things that kind of that we had looked at in terms of less interest rate sensitivity, kind of within the market, and why we didn't necessarily see as high a risk of recession as some other people did, kind of over the last couple of years. So if you think about kind of people in their mortgages, right, you've termed out kind of mortgages for 30 years over this last decade in a very low interest rate environment. Companies also did a very good job of terming out their debt over the kind of during that pandemic time period and coming out of that pandemic time period, right? So while rates are moving higher, they haven't felt the effects. Now, the kind of big question right now has been kind of around kind of the government debt load, right? And we had some commentary kind of from Treasury Secretary Bessent last week, suggesting that we weren't going to start to kind of term out that debt, for at least a few quarters, and that was one of the concerns that kind of was making its way through markets kind of earlier this year when we'd seen kind of 10-year yields moving up to kind of 4.8%.
Yeah, and let's suss that out for a second because 10-year yields were moving higher after the election and they were doing it at a pretty fast clip. And it's a lot of the guests that we talk to, most of them will say it's not the level necessarily, although there are some big levels like 5%, but it's the speed and it was just screaming higher. So what I would note now is the last few days we've had a little bit of a growth scare. Stocks have not been performing well. We've seen them come down off their highs with force, but those rates, the 10-year rate has been coming down as well. So, you could say that's maybe a sigh of relief, or if there's an actual growth scare though, and that builds, that's another dynamic. So, it's funny that the markets are just kind of on this fence. Is the Fed really, what is its next move? I think the market is kind of trying to figure that out. What do you think there?
Yeah, and I think markets do tend to move kind of very, very quickly, right? And we've seen kind of that narrative shifting kind of very fast, kind of over the last couple of years. If you think back to the start of last year when markets were pricing in 7 or 8 rate cuts, right, and then we backed that off and we ended up having 4. Kind of currently, kind of that back off from 4.8% to 4.3%, is pretty significant, right? And that goes to like one of the themes that I've kind of been thinking about is like markets have started to move in a way where they look at things in kind of a binary outcome where it's like all or none, right? So it's like we're either having an inflation scare, right, or we're going to lose control, right? We're going to lose control of of our balance sheet as a country, and then all of a sudden, like now we're right back to this kind of growth scare, right? And the conversation around potential recessions is starting to make its way back into markets.
What is a growth scare? High level.
It's so scary the markets don't like it.
Because we like growth, right? But we don't like inflation. What is a growth scare?
Yes. So, I mean, what we're seeing right now and how it's kind of playing out within the market, right, is that we've seen soft data, which is what we'd call kind of survey data, right? And that survey data historically has been a good leading indicator to suggest that the harder economic data, kind of things like retail sales, jobs numbers, and things of that nature, start to move. Will start to kind of move lower when you see that, kind of that survey data move lower. Now, that being said, over the last couple of years, that survey data has been very, very negative, despite the fact that the economy has continued to hold up. Right. So now, once again, kind of with the uncertainty that we have, kind of around policy, we're seeing that survey data, move lower. We had a very sharp move lower in the consumer confidence numbers. Right. There's a lot of concern. Kind of consumers are expressing a lot of concern around tariffs. Right. So there is this concern that we're going to start to see kind of the growth side of the equation and that hard data start to turn lower. I think it's a little bit early to kind of jump to that conclusion.
And Michael, last time you were here, we talked about systematic flows. And when we think about institutional investors, it's not just this monolithic structure. I mean, you got hedge funds, you got market makers, you have commodity trading advisors, the CTAs, and they all have, and there's a lot of divisions within them. But when we have certain events in the market, like you see stocks down 2-3% at the index level, a lot of times that can trigger various flows. And I'm wondering if you're seeing any of those kind of dynamics in the market right now.
Yes, yeah, I mean, and we have definitely been, we have been seeing, kind of some of those moves over the last couple of weeks, or particularly over the last, kind of week or so. But like there were some early warning signs, right? So while we had the S&P 500 hitting these new marginal all-time highs, you continued to see kind of small and mid-cap indices, kind of were underperforming, right? They couldn't even break above their 50-day moving averages, right? And then, beneath the surface, you talked a little bit earlier about kind of staples and consumer discretionary. You really started to see the consumer staples sector start to outperform that consumer discretionary sector, which can be, another one of those like kind of leading indicators that there's some concern, kind of happening beneath the surface. Now, over the last, kind of really starting a week ago today, we started to see that momentum unwind, kind of really begin, kind of late on the day on, kind of last Wednesday, kind of there were some insider sales announcements coming from Palantir, which has been a retail favorite, kind of, along with kind of the Department of Defense kind of cost cutting, and that kind of took the wind out of the sails of that stock. But you started to see, that kind of cascade through different, very kind of momentum-based assets, cryptocurrencies, and things of that nature. So we've started to see the VIX moving higher, right? And you see, kind of some of that risk reduction, kind of happening within the market more broadly. One of the things you can watch is at the end of the day, when you see markets moving in that final kind of half hour of trade, that kind of gives you the signal that you're seeing more institutional flows, right? So like the closing auction here on the New York Stock Exchange is the biggest trade of the day. It makes up, something, call it, around 15% of, normal daily volume. And when you see markets moving lower into the close or moving higher into the close, that's giving you a sense of where that institutional money flow is going.
But I do hear you talking about a rotation that the market had wanted. There was this interest in a broadening, and now the market's getting it, and they're unhappy about it.
Well, the market's never happy. Investors are never happy. So, yeah, how do you think about the rotation, though? Is it enough to sustain the bull market?
Well, so there's a couple different things going on with the rotation, right? The expectation that we would see the rotation within U.S. equities was for that to happen kind of down the market capitalization scale. As we're seeing kind of concern, the rotation we're getting is up the quality scale, right? And because there is some concern and there's more defensive posturing that's happening within the market. So we're seeing the large caps outperform, and that area where investors had been hoping to see kind of that rotation in the small and mid cap, that's been underperforming. In addition, what we're also seeing is international markets have started to kind of outperform U.S. markets, right? So you're seeing kind of strength in Europe. You're seeing, kind of China, which was, kind of, just not too long ago was considered, kind of uninvestable, right? Is all of a sudden, kind of coming back with, kind of, as we've seen stimulus coming into that country, and then, kind of the DeepSeek headlines, over the last few weeks, right? So you're seeing that rotational activity happen in ways that, I don't think most people were necessarily expecting.
No,
and
Trump's
it's happening.
president, there's Europe for you.
Yeah.
No, people didn't expect that. How long does it last? Is this sustainable for, is this a longer term trend that we have in the making?
Right. Well, so I'm not quite sure how, kind of how long the trend can continue, right? I mean, it's not, when you look at Europe, you can understand, right? We're seeing some fiscal austerity here, right? And you're seeing kind of more headlines about, kind of an increased, kind of fiscal spending, kind of happening at the European level. But it's not as if, kind of those economies are kind of gangbuster. The other, kind of the other piece of that equation is that you're looking at other areas of the market that are just trading at, nice relative values or cheaper than U.S. equity markets have, are currently trading, right? So that's, kind of giving you a little bit more of a buffer, and that's kind of helping, helping money rotate into those areas of the market. I don't think it necessarily, that can happen, and U.S. markets can also continue to, kind of perform well. I don't think it necessarily, just like kind of that binary outcome that we just talked about.
There's no
it doesn't need to be one or the other. I think both can perform well.
Let's talk about some nuance with respect to the U.S. dollar index, or just the U.S. dollar broadly. I look at the DXY, and it's kind of an old archaic index, but it does the job. It's well off of its highs, and when it was screaming higher with rates, that was a problem. Now it's not necessarily a problem, but given the international surges that we've seen in these stock markets across the world, whether Europe, China, or in between, is the dollar under threat? Does it weaken too much, and is that some kind of a signal that you would look at?
I mean, I think from a U.S. market perspective, right? I think some dollar weakness would probably be applauded at this juncture, right? That was been kind of in the Q1 earnings season, right? That dollar strength has been one of the headwinds that we've heard kind of U.S. global kind of multinationals have kind of called out in terms of a headwind from an earnings perspective. So I think if we continue to see the U.S. dollar moving a bit lower here, in the near term, that might actually be applauded from a U.S. market perspective. From a more global macro perspective, right?
This episode is brought to you by the number 77, and I'll back into this number's relevance. If you take an ETF for consumer staples like XLP and you divide it by consumer sentiment, XLY, you get a ratio of staples to discretionary, and that's the stuff we want versus the stuff we need. And it has been screaming higher recently, favoring staples. And so if we do technical analysis on this ratio, what we see is a relative strength index, or RSI, of the ratio is 77. We haven't seen a level that high since December of 2022. So Michael, we already talked about staples versus discretionary a little bit. Is this one of your signals? What do you look into this? What is the read through on this?
Yeah, I mean, I think the read through was kind of that early signal that kind of there's more concern kind of within the market. Now there's like just like the S&P 500, when you look at the those sectors within the index, right? They're very top heavy as well, right? So within consumer discretionary, Amazon and Tesla make up a very big portion of that. So it does skew, but I've also looked at it from an equal weight perspective, right? And you did see that signal was also triggering from an equal weight perspective, right? So I think like at those turning points, that's like something that can be an early indicator where you're seeing institutional flows, kind of looking for that safety, kind of for that safe haven, kind of within equity markets.
All right, we're going to get to today's Who Wore It Better right now. We have a runway showdown with interest rates. And this is featuring the short end of the curve, the Fed funds rate. That's the overnight rate that the Fed uses, and that's versus the U.S. 10-year yield. So it's short-term versus long-term. But don't let maturity get in the way, because the 10-year Treasury is free-spirited. It's strutting down the runway in real time, reacting to these market whispers, global money flows, and investor sentiment. It moves fast, it moves early, and it doesn't wait for permission. On the other side, the Fed's benchmark Fed funds rate is a structured power dresser. Every move is deliberate, calculated, and telegraphed well in advance. No unexpected jumps, no impulsive pivots. Usually, the Federal Reserve dictates the season's official outlook, whether its markets don't like it, whether markets like it or not. So right now, the 10-year is shouting growth scare, while the Fed is holding its ground, ready to pounce on inflation or economic weakness. So Michael, who is wearing the interest rate crown better? Is it the market's instincts, the 10-year, or the Fed's control?
Well, it's a great question. And look, I think like ultimately, right, the markets are kind of have been like leading the Fed, right? And we've seen that, kind of during 2022, we saw markets lead the Fed, kind of on the way up, it's suggesting that we're going to see many more rate hikes than the Federal Reserve, kind of had expected at that time, right? And now, right, you're getting kind of a cautious view from the market. I think you made a great point earlier, kind of in our discussion, right? It's something that I talk about all the time. It's not necessarily kind of the ultimate rate, kind of where 10-year yields are trading. It's how you're getting there. It's that rate of change, the second derivative, right? And that's been the concerning part of A, the move higher, and then B, kind of, the move on, in the other direction. The one positive, kind of outcome in what that move and where we are from an absolute rate perspective is that it is actually providing investors, some negative correlation. So when we are seeing equity markets, right, moving lower, right, the bond portfolio is actually
working now.
Right, it's working, right, and so we have kind of a positive interest rate environment, and there are other places for kind of equity investors or investors broadly to put money to work.
What should investors and just constituents know about the 10-year as a check on the Trump administration? Because you mentioned Scott Besant's commentary. Sure. He talked about the 10-year as a check and something that they were going to look at all the time. We previously thought that the stock market would be that check on the administration, and Besant said essentially, no, we want it to be the 10-year.
In 30 seconds.
Yeah. Well, I mean, Scott Besant, himself said he's the kind of the most important bond salesman, right out there. Yeah. So I mean, it is kind of very important. Kind of if you start to see that term premium, which is something we talked about in the last episode here, if you start to see that term premium and the demand that investors are kind of requiring to hold that longer term debt, start to move higher.
Mm-hmm.
All right, that wraps up this segment of Stocks in Translation. Welcome back to Stocks in Translation. Overtime. Thought we'd do something a little bit different today. In my never-ending quest to bring Sydney into the fold, her as a people's voice, by the way, into the fold in technical analysis, I thought we'd do some of that right here in our Yahoo Finance studios today.
I'm with you, Jared, because I'm more of a fundamentals girly. I am really curious. All the time on the show, you talk about candlestick charts.
Yes.
So can you help me understand a bit, kind of chart that out here for us?
You bet. This is Berkshire Hathaway. This is a 1-month chart. So each one of these candles represents 1 day in the market, and there are usually 21 of these or thereabouts in 1 month. And you're going to notice some of these are green and some of these are red. And the coloring depends on where the close is in relation to the open. So in a green chart, that means that it's gaining throughout the day. So it opens down here and it closes here. And it also happened to close at the very high. You're going to notice here, if you zoom in and squint, here's a red candle, but we have some sticks above it. It's actually called a wick or a shadow. And it's colored red because the close was lower than the open. So you can say it opened here, it probed a little bit higher, it decreased or declined, and then it kind of came off the lows and found a close that was in the bottom, say 25% of it. Now, we can expand this, and let's take a look at a year-to-date here of Berkshire. I think it's interesting to use candlesticks to kind of mark trends, and you don't even need candlesticks for this. We can also use a line chart, but I just happen to be partial to candlesticks, so let's go. I'm going to take this low down here. Then we're going to go to this high. Then we have a higher low, a higher high, higher low, higher high, and we're using the closes here. And it goes all the way up until we finally have this area where we are right now. So Sid, I don't know if you have any questions.
Well, I'm just trying to keep track of it all. So green body means stock closed higher. Red body means stock closed lower.
Yes.
The fact that there's no little wick over here means that the stock closed at this highest level.
Yeah, exactly.
All right,
Perfect. And the shadows are important sometimes because if you see a long one like this, and let me just draw this in, this has a long shadow to the downside, and you can see it's a red candle, so the close was a little bit under the open, and let me take the annotations off, but you can see this is actually a hammer formation. That's called a hammer candle, and sometimes that marks an interim bottom, and you can see it actually took out this low from 2 days prior. So it ran some stops there perhaps, and then it just accelerated to the upside. And a lot of times when that happens, the short sellers intraday, they get caught and they have to participate in the buying action in order to cover. So let's go back to our year-to-date here. We are looking at this uptrend in Berkshire Hathaway, but we can see a good example of a downtrend if we look at Tesla.
Looks painful.
Well, I mean, this stock has gotten cut in half off of its highs here, so pretty serious situation for the stock. It's been very volatile over the last few years, which I'll show in a second, but I just want to show here how we have a series of lower highs and lower lows, and really not a whole lot of wiggle room in between. It's just been when it decides to go down, it tends to go down dramatically. So this is year to date. I'm going to show you the 5-year chart, and let me put some lines on there so it's easier to see. You can see that's a whole lot of sideways, and markets are known for being tricky. One of the tricky things that Tesla did here was recently, late last year, it broke to a new high, and a lot of people thought that was a signal to go long, to add to their position or just to buy the stock. Well, that was precisely the point to sell, and so that was a little bit of a non-starter. Some people call this a little whoops to the upside. That's J.C. Peret's terminology, or you could just call it a failed breakout to the upside. Nevertheless, what I want to highlight here is that Tesla is just in the middle of this big trading range. Probably doesn't mean a lot until it goes below 150 or above 450. All right. We got a minute left, so I wanted to show you two different stocks, Palantir and Peloton. Palantir peaked in early 2021. They both IPO'd about the same time, and then it declined about 85%, and then it took off to the races. Peloton, guess what? It peaked around 2021, earlier in the year, got cut 90%, but it didn't take off. So these are actually two very similar stocks until the year 2023, and just kind of gives you some context into how different things have evolved, how two different stocks have evolved over the pandemic.
Yeah, it's interesting to see two similar things when they look so different, technically.
Yeah, as they do now. So that's the importance of also going back in time and getting some historical context. Start out with the longer time frames, work your way down all the way to the daily, sometimes even intraday if you want to go there. We're going to sign off here. That's all the time we have for Yahoo Finance's Stocks in Translation. Catch us next week for another scintillating episode where I try to bring Sydney back into the technical analysis foray.
I don't know if it's going to work.
Until next time.